Hi, I'm Kurt. I'm a value investor, and I love using value investing principles to analyze companies to determine their intrinsic fair value so I know whether I should invest in them and if so, at what price. Today we're looking at Apple, ticker symbol AAPL. Everyone knows this company. It's actually the largest publicly traded company in the world, and I'm going to do a stock valuation with a discounted cash flow model and financials analysis. So stay tuned, and if you enjoy this content, please subscribe and click the like button to recommend it to other viewers. So let's get into the presentation. This is based on early 2023 financials, so let's get into this analysis. Of course, the first thing I always do is show you all the main takeaways that I've done from analyzing a company. And the first item is always my expected future return based on today's price versus the intrinsic value of the company. And for Apple, that is right at 12%, which is it's a great return. It's not super amazing off the charts, but it's somewhere right there in that 10 to 15% range. We know that Apple is a steady company. It's a powerful company. It makes up a huge portion, even of the United States wealth and GDP. I mean, it's a $3 trillion market cap company. We know it has a steady product line, iPhone, MacBook, AirPods, and all those products they release, but it also has a growing services business, which contributes to their really high return on invested capital. Their returns and their income growth is going fast because of this services portion of their business, which is a very low capital intensity business to be in. The target price right now, based on a 10 to 20% target return, is about 20% below the current price, which means technically I think this company's a tad bit overvalued if you want that 10 to 20% return, but it just depends on where you are in that spectrum. As I've said here, if you want a 12% return, boom, you're fairly priced. If you want a 20% return, this company's overpriced right now. We also know that the company has fantastic fundamentals, but the one pillar that it has trouble with is that valuation. So if you're looking for 15 price to earnings ratio, you're not going to get it in Apple. So that valuation is a little iffy depending on what kind of return you want. But if you are okay with 10% returns, Apple is at a great price right now. You're going to get 10% returns with Apple based on my analysis. So the principles for valuation is something I cover at the beginning of the video just to show everyone, key everyone into what am I doing here? I mean, am I just saying, hey, this is a big company, it's going to grow? I mean, no, we need to put numbers to this and figure out what's going on. So the first point is that we always look at per share metrics, and tons of companies issue lots of shares to drive up sales growth, but they never convert that to profit. And if they do, that profit doesn't often justify the price of the company that you're paying. We always look at the per share earnings, the per share free cash flow. And if a company is diluting its shareholders by issuing new shares, that's a warning flag for us. But if a company is buying back shares that are undervalued or at good prices, that's a green flag, and we really like that if we were to buy into the company. We also look at free cash flow. It's not exactly the same as earnings or net income. It includes that capital expenses that are required to keep the business flowing, but this is the money that's left over for shareholders at the end of the day. And when we project that future free cash flow, if we can see what's going to happen in the future, we discount that future free cash flow to present value. So we want to know what's the current price that we should pay for all the future earnings of this company. And so we use that return target as our discount rate to make that adjustment. That's the third point you see here. Lastly, we're looking for healthy fundamentals. We're looking for a company that's predictable, that we understand the business and the fundamentals of the company, like has the revenue grown over the last 5 years, or has it been fluctuating, or what's going on with their profit or free cash flow? So we have other things like the dividend they pay. Is it sustainable? Or are they going to have to cut, which causes drama? Does it have a high return on invested capital? Lots of different things go into this fundamental analysis. We'll look at that later. We're just looking for businesses that have good quality, that have good predictability. They're not like crazy, and they're not going to make us lose sleep at night, and they have a great balance sheets, and they have healthy accounting. So we look at their debt as well. Let's look at Apple as a business. If we were just to zoom all the way out and say, what is the business of Apple? And most people know this because most people, or at least a lot of people, have their flagship product, which is the iPhone. And they have other personal electronic products like their MacBook or their iPad, and they have other things like the wearables, the AirPods and they have the watch and new things. I mean, I think they even just released their VR headset to compete with Meta. So they're getting to that metaverse space. So we all know the products they release and they're always innovating there, but they also have a secret business that I think is going to carry a lot of their future earnings growth, which is their services business. If you think about the environment, the ecosystem they've created with their users of their products, they have the App Store, they have music, they have Apple Pay. So they're getting into these businesses which are like pay per month for cloud storage, pay per month for reading books or listening to books and things like that. If you buy an app for $2, Apple's going to collect a percentage of that purchase. So they are making tons of low cost revenue from those types of things. And that portion of their business is really growing recently. And I think it will continue to grow. This is a global brand. It's the world's largest publicly traded company at a market cap of almost $3.1 trillion. And the price right now is $194 per share as of the day I'm recording this, with a 33 price to earnings ratio. And they do pay a dividend. It's a rather small dividend if you consider it that. However, they've been paying this dividend consistently for maybe 8 to 10 years now. And I think that this dividend is going to continue to increase. 20 years from now, this is going to be a dividend aristocrat or king. I mean, it's going to be one of those companies that pays a very consistent dividend, and the yield is going to be a lot higher into the future. One more thing about the Apple business that I just want to show here is the components of their business. Yes, we know about the iPhone. That's the blue bars you see growing there in quarterly revenue. But we're also look at the green bars. I mean, the services portion of their business has been growing in revenue, and that revenue converts to profit at a much higher rate because there's no physical product in a lot of cases that they have to produce. And so to me, that is a killer part of their business. It's a very high margin business, and it's the thing that's been growing in the last few years. You project that forward, and this could be really powerful. So if we understand the business in a basic level a little bit, I just want to review the price history of the stock. We don't necessarily want to focus too much on this, but we want to see what's been going on recently. Are we at all-time highs, which we are very close to all-time highs right now? I mean, we've passed this top that we had back in 2022, and we're closing in on $200 a share. But, does this fit the trajectory of the price of this stock? How predictable or consistent is the price chart for the company, which it's very high. I mean, the closer this number is to 1, the more consistent or the more it meets this trend line that I've drawn through, this exponential growth trend line. So this company is consistently moving in that exponential growth direction, which is a decent thing if you're looking for predictability. And a lot of times we're looking for companies that the current price is a lot lower than recent trends because we know that, hey, this might be oversold or it might be in that range where it can recover back. But in the case of Apple, you know what you're getting into. And the main thing is that the price was all the way down as early as January of this year in this trough, and it's sprung really powerfully back out. So if you're buying now, you're missing that opportunity that you could have bought back here, and the fundamentals of the business are roughly the same as they were then. So it's those kind of fluctuations that we just want to take a look at. And last thing we look at when we're doing an overview of the business is the management. If you're in the world of stocks and business, you know Tim Cook, the CEO, and how much Apple has grown under his management and leadership. But anytime you analyze a company, if you don't know the management, if you don't know the CEO, I implore you to just do a quick Google search, look for some interviews. Right here, I pulled up just a YouTube short of Warren Buffett, who we really respect as like the king of value investing. And we know that Berkshire Hathaway, his company, his investment business, is in Apple because Warren Buffett 7 years ago saw that, hey, this is a business that we want to own because this business is growing. So let's see what Warren Buffett has to say about Tim Cook.
In his own way, it's a different way, but Tim Cook is, we see a lot of managers of a lot of businesses, and you're looking at two great ones on both ends here. He's handled that business so well. He couldn't do what Steve Jobs obviously could do in terms of creation, but but Steve Jobs couldn't really, I don't think, do what Tim Cook has done in many respects.
Okay, so I mean, that's to say that Tim Cook is the best CEO, and that even Steve Jobs couldn't do what Tim Cook is doing. I mean, in some respects, I mean that is powerful language here from Warren Buffett. So Warren Buffett believes in Tim Cook. So let's get into the financials of the business. What has their revenue looked like recently? What is their revenue trend? Here it is, going all the way back quarterly. This is, but it's a 12-month rolling average, all the way back to 2010. So you can see what's happened right here during COVID, the bump in revenue they got, and a little bit of flattening out that they've had in the last year, which a lot of companies throughout the economy have had to deal with. But look at this trend. They do fluctuate, but it's an upward trend. There's the growth history annualized over the last 3 years, 13%. 5 years, 12%, and 10-year growth at 10% on the top line revenue. And let's look at how that's converted into net income. Again, 12-month rolling average here, same sort of fluctuation, but after the pandemic, with this easing monetary policy environment we've been in, we see more of an explosion. Yes, revenue went up, but their margins also went up. So something's happening here, and it's also declined more since that peak. But look at the annualized numbers here for the trend in net income. Over the last 10 years, their annual growth has been 18% in profit. That's really good. But the really impressive thing is that it's not much lower when you look at the 5-year level, and it's the same if you look at the 3-year. Of course, we've had this big surge, but the point there is that this is consistently growing and it's not leveling off yet. So there's lots of people that would say, oh, Apple's an old business now. They're going to start to stabilize because their products have reached like peak capacity, but no, they have other business there. They have growth left to do. It looks like they're still on that growing upward trend. And let's look at how that net income has converted into free cash flow. So this is sort of the final picture that we look at as investors. I did a trailing 1 year in the black line. It's a little bit more jagged, but I smoothed it more and looked at the trailing 2-year average, because we know that capital expenses can be very cyclical. So you can see this growth here, and here's the historical annualized growth rates over the last 10 years has been 10% per year. And that number has only gone up in recent years as they've been able to generate more free cash flow yield. And so my forecast going into the future is that we should start with a base of $85 billion. That's a little bit conservative because you can see right now we're hovering around $100 billion yearly free cash flow. But if we set the base somewhere a little bit lower, just in case they decline more, and let's set the current year base around $85 billion, and let's grow the company over the next 5 years at 12%, and then over the longer term at 7%, and then at the 20-year mark, let's make their terminal growth 3%, which is the highest I ever do a terminal growth rate for a company, because all companies come to an end and no company can grow in perpetuity faster than the economy. So that is my assumption here for the growth and free cash flow of the company into the future. Well, a couple more things that we want to look at is, first of all, shares outstanding. And so you can see they have declining shares outstanding, which is good for current investors because it decreases that total shares out there, but that really helps grow the stake in the company if we own a piece of it and the number of shares is decreasing because the company has chosen to buy back shares. You can see the rate of buybacks is 5% per year over the last 10 years. And I mean, that is really high. I don't see that very often. That's a very committed, consistent buyback program. And it has slowed down a little bit in the last few years. They're only down 3.5% per year in the last 3 years. But I mean, that's still a really high rate. And it's been very consistent. They don't fluctuate. I mean, every once in a while, you see it tick up in shares outstanding, but it's always followed by consistent buybacks. So I think the management is doing a really great job in that decision. Let's look now at the per share metric. So when we take that declining share count into account with their net income in pink and their free cash flow trailing 12 months in green, we see this trend here, which is really what this shows. The fact that these two lines are very similar shows that their capital expenses are very predictable. It's not a super capital intensive business. I mean, that is awesome to see. And when we look at the annualized numbers here, we see over the last 10 years, 14% free cash flow per share growth per year. And for net income, it's 11%. And look at the numbers here for net income per share in the last 3 years, 5 years, and for free cash flow. Again, those are really high numbers. But the main thing is that those numbers are higher over the last 3 and 5 years than they are over the last 10 years. And that means that this company has not finished growing. Let's look at their return on invested capital, which is an important part of the business. How efficiently can they grow the company? How can they do they have ideas that they deploy their capital and it makes returns? And for Apple, that's a major yes. This is the innovative company. This company knows how to deploy capital. And as of 2017, that number has grown extraordinarily. I mean, it was edging back up, but it never has gotten as low as 25%. And we say, where I put this black line, anything above 10% return on invested capital is good. For a tech company, anything above 20% is phenomenal. And this is this company is, what I can see, is like amazing at deploying capital. You can see they're getting close to 75%, which is just ridiculous. And a lot of that is because of the pandemic, what's happened since then with the monetary cycle and just the flow of money around. But even if this caves back down, it looks like they can hover in that 25 or 20 to 30% range even. I mean, but most of their history has been above that. But if it stays there, I'm happy. And of course, it's increasing currently because of that. Again, because they're getting into the business of things where they don't have to deploy a lot of capital, and they're still reaping the rewards of all their users who will pay them monthly fees for regular services. Lastly, we want to look at their balance sheet to see what's going on here, because of course we can tell what's happening with the free cash flow, but maybe they have a lot of debt. Maybe their debt is unsustainable. Maybe they can't pay the debt with the free cash flow. So that's the last thing we look at. Now, a couple things just right off the top. Their assets, $330 billion, and $270 billion in liabilities. So that is a lot of debt. They only have $56 billion in cash on hand, which the fact that I put the word only in front of that is kind of mind-boggling. But relative to their debt, I'd say that's actually fairly good. When you look at their current liabilities at $120 billion, that's debt due in the next 1 year, and the cash can easily pay about half of that. I mean, plus they have all their receivables. So I don't see a problem here with their debt. I love the fact that they don't have intangibles on their balance sheet, because what that really means is that their total assets is actually a lot higher than that, because they have a brand power that's, you can't even put on paper how powerful their brand is. And the fact that they don't list that on their list of assets is really important. I do subtract a little bit from property, plant, and equipment always when I do this quality asset adjustment. And so I say their net quality assets, when you subtract liabilities from their adjusted assets, is about $50 billion. And on a per share basis, it's $3.26. So with a company that's trading almost at $200 a share, the balance sheet as a component of their market capitalization is very low. So it's not a major factor here, but we just want to go through and check that. Now, the pillars analysis is something that I do just to say, okay, is this a stable business? Is it a steady business? Do they have too much debt or something like that? And you can see most of these check marks are all green. The only check marks that give us trouble are the valuation check marks on the PE ratio, and we do have an X on the free cash flow valuation. So valuation is the only question mark here. It's like, what price do you want to pay for this company? But other than that, it's a perfect company. It meets all of my basic check marks, and it exceeds them to a huge extent. So my point here is that Apple checks 7 of the pillars and 18 out of the 21 sub-pillars. And so it's extremely fundamentally sound, which leads us to our valuation. What is the intrinsic value of Apple stock? Well, I use various discount rates here on the left, and I show you when I discount by each of these discount rates, this is the per share price and the market cap that should be paid for the company. I also put a margin of safety over on the right-hand side. By the way, the safety factor is that price relative to the current price of the company, which is $194 a share. On the right, I have a margin of safety analysis where I just include a margin of safety, in this case 15%, and I discount the evaluated price by that amount to show like a safety factored price of the stock that you should be willing to pay at each discount rate. Where does the current price fall in this range? I have it at about 12% anticipated rate of return. And down here, I put my 20% low and high assumption for 15, and low and high for 10% return. So if you're looking for a 10 to 20% return on your investment, when you average these things together, you should be willing to pay $180 for Apple stocks. This is kind of a rough rounding here, but that's very close to the $194 that Apple stock is today. It's about 10% overpriced, but again, that's 10 to 20% return. It's like asking the question, what do you want? Do you want a 15% return? Because if you do, you should pay about $110, $115 per share. But if you're okay with a 12% return, this company's valuated perfectly. If you want a 10% return, you should be willing to pay like $350 per share. And this company's not even at $200 a share. So, I mean, that's the slight difference. 10% to 15% can make a huge difference when you're talking about discount rates into the future, and when you're talking about the present value of all that future free cash flow. So my main takeaways, or my summary, I guess I should say, for valuating Apple stock is that this company is just about at intrinsic value, just over, if you're looking for that 10 to 20% return. You should expect about a 12% return. It's the closest guess I can give you. If you bought the Apple shares at this price, it's a near perfect business when it comes to the fundamentals. The valuation is really all about the future growth assumptions. Is this company going to stabilize because of that products trend where they can only sell so many iPhones, they can only sell so many products? Or is this services component of their business going to allow them to continue that really high growth? That's a question that you have to ask for yourself if you want to invest in this company. I can do my best to project the future free cash flow, but my assumptions aren't perfect. This analysis isn't perfect. You have to answer those questions, and you have to create those assumptions. Other question marks around this company is like AI. How is that going to impact Apple and their ability to earn money on their services? The metaverse, they just released that VR headset. Is that going to be a sizable component? Is that going to be a flop? Are they going to waste a lot of capital expenses on developing something that doesn't end up working, that's just a fad? Or what's going to happen there? Payment services, that's a huge industry, and Apple, could they break into that? Could they disrupt? Could they get into that PayPal sphere where all of the Apple users, all of the iPhone users are able to exchange money very easily? I mean, that would be huge, and where Apple's collecting a little bit of that, that's a huge deal. So another question mark here is it too late to buy Apple at a deal, at a bargain? Because remember, earlier this year, they were down 50% from where they are, or rather, they grew 50% from where they were just in half a year. The price of the stock went up 50%. So you've kind of missed that run. So I'm doing this analysis sort of after the fact, but still, it's like, what are the limits in the long-term future? You can see that maybe if we had valued this 6 months ago, we might have said 18% or 23% expected future return. But right now it's at 12%. So we've sort of missed that portion. So that's a thing that you've got to ask yourself, am I okay buying in at the all-time high? Overall, I give Apple a 7 out of 10 on the total value rating. And that combines the fundamentals, but it also combines where's the price of the stock relative to its intrinsic value right now. I would say it's in about the top quarter of companies that I've evaluated. I don't own Apple, and I would probably not buy it at this level because 15% is something that I'm aiming for. And even with a company as solid as Apple, if I can't really foresee 15% returns, which the price is just a little bit too high for that. If this company fell back down below $150 a share, I would give it another really good look. But that's my analysis. That's the results of looking through Apple's financials and doing a discounted cash flow analysis. If you really enjoyed this video and if it benefited you at all, please leave a like and please comment down below, what do you think of Apple? What price would you pay for it? Do you own Apple's stock? And so thank you guys for tuning in and watching my stock analysis video. Go check out another one, and until next time, best of luck and stay wise, stay blessed.